Hello, everyone, and welcome to the show today. So today we're going to be diving in. We're going to be talking about three of the biggest reasons that people fail building business credit. Look, I do a lot of training, and there's training out there that teaches you how to build business credit. But what people don't talk about is why people fail. All the people that try that don't succeed. As a matter of fact, a lot of the training out there, even I release, may make it out to be where it's easier than it really is. So we're going to dive into the mistakes that I see, why people fail, the hundreds, if not thousands, of comments to YouTube videos and where everybody gets stuck. And then I'm going to help you not get stuck. I'm going to help you avoid getting stuck, or if you're stuck now, getting unstuck so you can successfully navigate this process. For those that don't know me, my name is Ty Crandall. I'm CEO of Credit Suite. In the last few years, we've helped about 15,000 people build business credit. So I know a lot about this topic. If you have any questions along the way, feel free to give us a ring, 877-600-2487. You can visit us online at creditsuite.com, by email, info@creditsuite.com, or you can also go to creditsuite.com/EIN to grab your free guide on building business credit. So business credit is credit which is tied directly to a company's EIN number, not the owner's social security number. So business credit is really the only legal way you can have two credit profiles. You have one for your business and you have one, for example, as an individual. Hence, a business needs to build credit to buy the goods and services that it actually needs to grow. The way I explain what business credit does is it allows your business to fund itself. You build a credit profile and score for the business, and then you use the credit profile and score you build to then start getting credit. So basically, you're letting the business fund itself. So inquiries for business credit do not show up on the personal credit report, so it doesn't adversely affect your personal credit scores. The other huge benefit here is that with business credit, it doesn't adversely affect your ability to get loans and credit lines. The problem is that when you use personal credit to build, to get credit cards for your business, well, those inquiries prevent you from getting access to a lot of loans and credit lines you could have got without the inquiries. So by keeping the inquiries off your personal credit report, it helps make you more lendable for loans and credit lines. And an entrepreneur's business and personal credit scores are very, very different. Business credit scores can be built much quicker than consumer credit scores. Consumer credit scores have factors in them like utilization, which affect the 30-year score, which means if you get credit cards and use them, you're punished. But in the business world, we expect that to happen. So with the main scores of the business world, no aspect of the score has to do with utilization. Some scores it does, but the main scores that are used, it doesn't. It's basically based on payment history, which makes these scores easier to obtain. So with two separate credit scores, you can get two separate cards from the same sources. And this is a big thing. So when you're building business credit, you can not only have your Staples consumer credit card, but you can have a Staples business credit card, a Lowe's business credit card, an Amazon business credit card, as well as your consumer credit card. So it gives you twice as much credit, and it basically doubles your borrowing ability as a result of that. Now, business credit scores, as I mentioned, really only rely on you paying your bills as agreed. This is why it's such a great solution. It could be built quick so fast is because your scores are based on how you pay. So if we get you credit that reports on your business credit reports and you pay that on time or early, the one thing and only thing you needed to do was to pay it on time or early. And if you've done that one thing, then that's what will greet you with good scores as a result. Personal credit scores, again, depend on payments, but there's also factors like utilization, inquiries. Those things just are not part of business credit scoring. Experian, it is. About 15% of Experian's credit scores has to do with some of these other factors. So it looks at payment history and utilization. It looks at age and industry and size of your business. But again, even then, 85% of your score is based on payment history. With Dun Bradstreet and Equifax, it's 100% based on payment history. So good business credit, as I mentioned, will also help you get approved for loans. Business credit is important for your business to get money, as consumer credit is for you as an individual to get money. If you want to get approved, if you want to get the best rates and terms, if you want to get the most money in the consumer or business world, then a lot of those factors are primarily based on the quality of your credit profile. So failing to build business credit. Look, building business credit is far from guaranteed. Not everyone gets to the finish line. As a matter of fact, the way I explain this is that Like if our clients get to the end result in about 4 to 6 months, we see people that are trying to do this on their own take over 2 years in a lot of cases. So how could one person get to the same place in 4 months and the other person take 2 years to get there? Well, it's because a lot of people give up along the way because they're making these mistakes and don't even know that they're mistakes. So there are 3 big reasons why we see these failures happen, and they can all be prevented, which is what we're going to go into in about an hour as time worth today. So the very first reason that most businesses fail to build business credit is because they skip the very first important step, partially because we're entrepreneurs that all have ADD and we don't want to do the basic stuff that's necessary to build the foundation. And that's one of the biggest mistakes that you people make right from inception. So there are startup companies everywhere these days, and they're starting in small rooms or garages in people's homes. Someone has an idea, they decide to monetize it. So far, so good. Okay, but most companies fail in the first year, and often you'll hear over half will fail. We hear all these kind of statistics of business failure. It's just a matter of what time frame we're looking at, whether it be 1 year, 3 years, 10 years. So according to Vestopedia, it's more like 30% are going to fail, and that's in the first year alone. As a matter of fact, when we look at business failure statistics, the first 3 years, it's pretty much an aggressive drop, meaning most of the failures take place and they taper off if the business is able to make it more than 3 years. But again, half of those are failing in the first year, 5 years, and 2/3 are in the first 10. So most businesses are failing early into the process. So understandably, lenders get nervous and they want a company to have more than just an idea or extra space in their house to have an office, right? The business can be small, but it still needs to feel credible to lenders. Okay. And this is what's very, very important. What people don't understand is that when you go to borrow money, there's really only one thing that the source that you're borrowing money from cares about, whether you're getting a credit card or a loan or a credit line. They only really care about your ability to pay them back. That's what it comes down to. But here's the problem. If you're not supplying personal credit, well, then they don't know what your history is of paying your bills. If your business credit's not really well established, well, then they can't look at your business credit to determine how you've paid your business bills. So the default, the only thing they have is your application information. And you have to think of it like that way. So when you go to get business credit, you're not giving them access to personal credit. You don't have any business credit established. All they're going to do is be able to scrutinize that application. That credibility becomes very important really early into the process. It becomes even more important when you don't have your business credit established. So it all starts with professionalism. The business must look like a business and not a hobby. It has to have the trappings of a business. So here's the good news. Once you understand this concept, once you understand that lenders and credit issuers have a secret set of standards you must meet to get approved, you either meet the criteria or you don't. If you meet it, you get automated approvals. And if you don't, you typically get pushed to a manual review, which usually ends up in a decline. I'm not teaching you anything. If you think about it, you don't already know. Because every time you've applied for a credit card, the same thing happened. You either got an automatic approval right away, which was a computer, or you got a message that you'll hear by mail in 7 to 10 days. And although I do joke, and I often say that message is never good, it sometimes can be. My wife just got a pretty high limit credit card, and the notice she got online was that she would hear by mail. And the reason that they gave her that message was they had a question that they needed answered before they processed the application. But the bottom line is that 9.9 out of 10 times I've seen when you hear by mail, it's a denial, because what they're telling you, the reason it takes 7 to 10 days is because they have to manually review your application. And that's not what we want. We want these automated approvals every time we can get them. So you need to be credible to lenders and vendors. I should add, you need to be credible to lenders and vendors, computers, right? Computers are making these decisions. What you and I have to do is understand what these algorithms are looking for and then feed them what they want. By feeding them what they want, that's what gets us these automated approvals. So you've got to be professional looking in all aspects, including website and email address. The problem is if you leave these fields blank on an application, it throws up red flags. If you're using Gmail and Ymail email addresses versus like info@creditsuite.com, like your email is linked to your domain, it throws up red flags. You have enough red flags, you get pushed for a manual review. So it's very important when I talk about credibility, you could miss 1 or 2 of these points and still maybe get approved. Maybe some sources will approve you, maybe some sources won't. But by making sure that all these credibility points are in line, that's what will get you approved with almost all sources. And the more of these points you miss, the more chance you face of either getting denied or the more sources just absolutely won't approve you. So plus business phone and fax numbers need to be listed on 411 as well. So have that professional email website. Now, the website when it comes to business credit doesn't really matter. You need to have it. That application field needs to be filled out, but credit issuers aren't looking to research your business before issuing you a credit card. Lenders will. So the website needs to have a pretty good idea. It needs to be crystal clear of what you do and have a description of your services, because when it comes to getting loans, that's what lenders are going to want to see. Credit issuers, not so much. They just want to know you have a website. So I've always learned that within 2 seconds or less, somebody should be able to look at your homepage and know exactly what you do. And that means right center of your header needs to say exactly what you do. It needs to be clear, because that becomes important when you start getting loans and credit lines. You need to have a business phone number. You never want to use a home phone or a mobile phone on a business application. These applications, these lenders and credit issuers have the same technology that we use. And our technology will tell you the minute you enter a phone number what kind of phone number it is, whether it's a home phone, a cell phone, a business phone, a voice over IP. Voice over IPs and business phones are fine. You just never would want to use a mobile phone or a home phone as your business phone number. Another little nuance is you got to make sure that phone number is listed with 411. You can go to list yourself to do this. And this is the reason why. Usually you can't go to 411. As a matter of fact, 411.com is not even 411. It's two completely separate different companies. So you can't go to 411 and list your number. They organically pick up your business when you go to Google and Bing and when you start showing up everywhere. So this is why credit issuers look at this so heavily in the beginning, because if you're not listed with 411, they could tell you're a newbie, a startup. They could tell you're not established right away. But if your number is listed with 411, usually that only happens with a little bit of a seasoned business that already has an online presence. So this is why they look at this factor. So you want to get the phone number listed with 411, because if you don't have that online presence with 411, that is a huge red flag with credit issuers, especially with initial credit issuers that will give you business credit, which is why it's so important you get that done. Same thing with a fax number. The idea here is to never leave a field blank on the application. Are you going to get denied because you don't have a fax number? No, you won't. But it will throw up a red flag. And if you have enough of those red flags, you get denied. And that's exactly what we're trying to avoid. Also, the phone number should be a toll-free number. You want to get an 800 number, an 855, 877. It needs to be toll-free, because nowadays, unless you're like a local pizza delivery company, you need to have a toll-free number, because with the internet, we're doing business all over the world, if not all over the United States. And the only companies that are local are the ones that would not need a toll-free number. But again, having a toll-free number just is seen as you being more credible. So a credible business will need its own brick and mortar business. You need a physical address, a real business location. But let's say you don't have that because you work from home. That's okay. Get what's called a virtual address. A virtual address, you can go to creditsuite.com/virtual. That gives you a great link to save some money with Alliance. That's who we've tested, Regis and Alliance and all of them, and they're the best ones out there with the virtual address. A virtual address is just simply where you're renting an address to get mail without renting the physical location, the space. Much cheaper, obviously, just to rent the mailbox, but it's not a UPS address. It's not a PO box address. Those are absolute no-nos. You cannot use a PO box or a UPS address. Why? Here's why. Back in the 80s, what happened was they started putting these into a database, and the virtual assistant or the virtual address companies, Regis and Alliance, I know these guys, these CEOs know each other. They go back a long time. They fought a battle and won to keep virtual addresses out of that database. Now, it was in the 80s. And at the time, nobody even really thought anything about it because the internet was really not even there. But now with the internet, what's happened is all these PO boxes and UPS addresses are housed in a database that lenders and credit issuers cross-check when they're issuing approvals. And a lot of these things I've told you won't get you immediate denials. These will. PO boxes and UPS addresses will get you real denials. They'll get you denials just because you're using one. You're better off to use a home address than using that kind of address. So choice one, real physical address. Don't need one? Get a virtual address. It's your best second option. Third option is to go and use your home at last resort. But you have to keep in mind, places like Walmart will not approve you with a home address. You also need to keep in mind, Dun and Bradstreet now includes Google Street Views of your business location. So that means anybody that physically looks at your credit report will physically see a picture of your home on the credit report if you're using your home. So these are just things to keep in mind if you decide that you want to use that home address. Some things to at least take into consideration. A company will also need a business bank account devoted strictly to it. Now, when you get into loans and credit lines, this becomes really, really important. Guys, people like Fundbox, you can go to creditsuite.com/fundbox, PayPal, Square. These guys will give you money if you've only been in business for 3 to 6 months. But you have to have a bank account in order for that to work at places like Fundbox, and you should be having transactions go through PayPal and Square to get financing through them. The reason I'm telling you this is that a lot of loan options open up for you when you can prove money is going into a business bank account. So you should do this immediately. The minute you start your business, you should do it. Also, because of shelf corporations and junk like that you want to stay away from, which we'll talk about later, they also look at the date you open your bank account as the inception of your business in a lot of cases. Lenders and credit issuers do, especially if there's an ownership change. But for business credit purposes, why we care about this is that a lot of sources will ask you for a bank reference. Business credit sources will not, business credit cards, they're not going to verify your bank account, right? When you go to get a consumer credit card or a business credit card, this is unsecured money. There's no collateral and it's no doc. They're not getting bank statements. They're not getting tax returns to get a credit card. So they're never going to look at this bank account, but they're going to ask you for bank references because you won't have a bank reference unless you have a bank account. So that's how they verify you have one. A company must have all the licenses necessary for operating. There are some vendors out there like Granger. Granger will pretty much automatically give anybody with a business license $1,000 worth of credit to start building business credit and to buy stuff, obviously, with them. So if you have a license, they automatically approve you. Now, some businesses don't need licenses. Some businesses, the county and state doesn't require them. But if it does, this will help you. It makes you look more legitimate. Okay. And again, everything, including the licenses, need to have the exact business name, the business address. Everything needs to be the same business phone number. It's got to be congruent. This is the biggest problem that we see. We have a lot of people come in for loans that have this problem. They come in, they go, I went to my bank and I got denied. And we go, okay, well, let's do a check and make sure that all your information is good. 90% of the time, the information that they have on their application does not match what's found online. And in a lot of cases, it doesn't match exactly with the Secretary of State records. And that becomes a problem because when these credit issuers or lenders are looking at the data with the Secretary of State to verify against your application, when it's different than what's on your application, it automatically results in a denial in a lot of cases. So this congruency, making sure your business name, your address, your phone number is the same on all of your utility statements, your bank statements, all online listings, your Secretary of State is probably, if not one of the most credibility points I can tell you. And I'm going to probably just say it's the most important. When we look at loan denial stats, why banks are actually denying loans, this incongruency of information is one of the leading causes. So this is probably the number one thing you need to do is make sure that all that information is congruent. Okay, business credibility also means taxes. So register for state taxes. Now, it's different in every state. You might not have to register for your state taxes. In Florida, when I come in and I actually set up a business, they send me tax bills that I then have to complete information like every quarter and send back to them. So it's different in every state. In some states, you'll also need to register for city or local taxes, and you also need to register with the IRS, which is basically getting that EIN. Once you get your EIN number set up, that becomes very important to get registered with the IRS, and you also need to select the right business entity as well. Now, a business entity is commercial, corporate, and or other institution. It's formed, administered as per commercial law in order to engage in business activities. Look, it's real simple if you think about it. A social security number in the United States is how our government recognizes you as an individual citizen of this country. An EIN number in the United States is the IRS and our government's way of recognizing that your business is a legal and legitimate business in the United States. So an EIN is important for your business as your social is to you. It's what identifies you as being legitimate and real. Now, don't get me wrong, you can actually operate without an EIN. You can be a sole proprietor without an EIN. But again, if you really want to be seen as credible and legitimate, you've got to make sure you get that EIN number. Okay, it's very important. So essentially, an entity is what allows a company the ability to law to conduct a business. So I talked a little bit about the EIN, but that is what the entity is. So the entity is where you go to the Secretary of State, you set up a corporation, a sole proprietorship, a partnership, et cetera, et cetera. Now you could build business credit with any entity, but again, LLCs and corporations will give you the most credibility. Sole proprietors, for one, makes you look like a novice, makes you look like a newbie, makes you look unestablished just because of the entity you choose. So really try to stay with LLCs or corporations. It's going to give you the most credibility. Okay, the IRS recognizes the following business entities we talked about. Okay, sole prop, partnership corp, and S corp. An LLC is not considered a separate entity by the IRS, but you can have your business set up as an LLC. You should choose C corp, S corp, or an LLC should be the entities that you choose. So business entity choices control the taxes, the cost and shares, legal liability, many things. For me, in my world of building business credit, we care about liability. That's what we care about. So my goal is to make it where you're not personally liable for your business debts. If you are a partnership or sole proprietorship, you are the business. And I'm not an attorney and this isn't legal advice, but if you ever get sued, then the business gets sued, you get sued. You and the business are one and the same. So if you want to separate that liability, you have to separate yourself from the entity. Sole proprietors are the same as the businesses they own. As I mentioned, the owner pays the taxes on the sole proprietor partnership. There are no limits at all on personal liability. If the sole prop did it, then so did its owner. This is why you're liable for everything in the business, which is so insane that you would voluntarily choose that. You do not want to do that. This includes all debts, obligation, any risk from actions of employees. The owner is the company. Again, it just makes sense. You've got to separate yourself from the business, because even if you do nothing wrong, there's so many crazy nut jobs out there that could sue the business for any known reason. Especially the bigger you get, these becomes real possibilities, and then they could take you down with it even though you've done nothing wrong, and it's just not something you want to deal with. So a partnership does not have to pay income tax. Instead, the business will pass through its profit or loss to the partners. Then the partners will include their respective share of the partnership's income or loss on their personal tax returns. This is the same with S corporations. You have to kind of decide whether or not you want the profits or loss from the business to show on your personal taxes or not. And I'm not an accountant. You should talk to one if these are things that are of concern. But if you're a C corporation, for example, the company then is the one. The company is the one that's actually incurring the profit or loss. So the problem with C corps, which is what we are, is that it's kind of double taxation. The company pays taxes and then you pay taxes as an individual. If you're an S corporation, for example, then what happens is the taxes, the profit and loss carries to personal taxes, and you're only paying that on the personal side, not on the business side. So I'm not an accountant, and I'll tell you from our perspective, it makes a lot of sense from an LLC or an S corp to get started. And then if you start really getting big, $1 million plus, you probably want to convert to a C corp because you don't want those kind of profits and loss extending over to your personal taxes. And then the partners retain full shared liability in that case. So they're not only liable. So they are not only liable for their actions, they're liable for the actions of their partners. Partners are also liable for any business debts and decisions made by other partners. And all the partners' personal assets can be seized to satisfy a partnership's debt. Not good situation. You partner with somebody, they do something stupid, somebody sues the business and comes after your personal assets. Obviously something you want to try to avoid. So partner shares vary, and they could be clearly spelled in the partnership agreement. So corporations must pay state and federal taxes. They sometimes also pay local taxes. They'll include paying income taxes on profits. This is the opposite of partnerships and sole proprietorships. So corporations, basically what happens is the corporation itself pays the taxes, not you as an individual. So now we're starting to separate these. We're starting to separate you from the business. Corporation can end up paying taxes twice. First when it makes a profit, and the second time when dividends go to the shareholders. This is what I said. The problem with the C corp like we are is we get double taxed. The business pays taxes Then I get my money out of it, distribution or my pay, and then I pay taxes. So it's like you're getting double taxed. But if that's a concern, then you could do an S corporation, still have the protection of a corporation, and not have that happen. So within a corporation, the shareholders' personal assets are protected. Shareholders can usually only be held accountable for their investment in the stock of a company. So your personal assets are safe and secure. Why do you care about this? My story is the perfect reason of why you need not do this. Okay, my first company was a mortgage company. Company failed. We defaulted on business debts. Business debtors came after personal assets. And then what happened was they ended up cleaning out our personal bank account because of business debts. That's what we're trying to prevent here. It's the same thing that Inc., Entrepreneur, SBA, Score, all of them are also saying you want to build business credit to separate this liability for the same reason. So again, if an employee commits fraud or a felony under the corporation's direction, the corporation's veil can be pierced, which means that we've seen cases before where owners of corporations are held personally liable for cases where people die, for example, because of mismanagement of the business. So I'm not saying that you're completely protected. Like you or employees or your business could do really stupid stuff that could really harm people. Okay. And then as a result of that, you could then absolutely be sued because of negligence amongst many other things. So you're not fully protected, things to keep in mind. Then personal assets could be on the line. The solutions to tell employees not to commit fraud or felonies. I don't think that's the solution. I don't think telling your employees to not commit crimes is probably going to work. But running a solid organization and having safeguards in place where you're actually keeping up with what's going on in the organization to see if people are doing things wrong, that is something you should be doing. So a corporation is run by its board of directors. These people are usually also the owners. Ownership stakes are defined by which percentage of stock everyone owns. And if one person has a controlling interest over 50% of stock, then their decisions will generally overrule everyone else's. There's a couple boards you can get. You can get board of advisors, which have no ownership interest. You can have board of directors where they do control what's going on with the business. And we've seen before where CEOs are ousted of their own business because of decisions that the board of directors made. Like Steve Jobs and Apple's a perfect example of that happening. So things to keep in mind along those entities. So shareholders with smaller stakes in the corporation will sometimes band together. In this way, they can influence decisions or even eject board members. So you got to be careful of who you put on the board. And you don't have to have a board, by the way. A lot of corporations don't have board of advisors or directors for many years. Then they get board of advisors, and then they end up getting a board of directors. Profits are generally distributed per share percentages. So again, if you own 50%, somebody else owns 25, somebody else owns 25, you have a shareholder agreement that says this much of the profit is distributed and you get 50 and those other two people will get 25, 25. Okay, and a lot of times board members do get paid. They get a salary. As a matter of fact, I was talking to a guy the other day that serves on a board of a big publicly owned company. He makes $220,000 a year just for sitting on the board. He doesn't even work within the business. He just sits on the board. Now, in all fairness, he was one of the original founders as well. Corporations nearly always have a registered agent as well to accept service of the process. So only the wages of any S corporation shareholder who's also an employer are subject to employment tax. And again, if you want to be a corporation, you could choose between C and S. S means that those profit and loss goes to your personal taxes. C, that doesn't happen. With an S corp, any remaining income is paid to the owners as distribution. Distributions are taxed at a lower rate if they're taxed at all. An S corporation shareholder's personal assets like personal bank accounts cannot be seized, so it gives you a layer of protection. A shareholder working for a S corp must pay him or herself reasonable compensation. The shareholder has to get fair market value as well for their work. Otherwise, the IRS may reclassify any additional corporate earnings as wages. That's what happens. So you have to be really careful here because a lot of times it's considered tax evasion if you go too long as a 1099. Again, I'm not an attorney. This isn't legal advice. I could just tell you what comes from our accountants. A lot of people pay themselves as 1099s because they don't like to pay taxes. And then eventually you get big enough for accountants are like, oh, absolutely not. That's tax evasion. You have to do it. Meaning that the IRS is going to find a way. So if you're not paying yourself, then what happens is eventually that catches up and they're going to possibly intervene or send you all kinds of warnings. An LLC is a separate entity. It's not a separate entity according to the LLC, so it isn't taxed. Instead, its members pay individual taxes. Members of an LLC pay an employment tax on entire net income of the business, and LLC members are protected from personal liability as well for the business decisions or actions of the LLC. So if the LLC incurs debts or is sued, the member's personal assets are usually exempt. This is why you have a layer of protection, which is why it's called a limited liability company. But not always, hence the term limited liability. An LLC is another type of corporation. The only real difference is liability rather than shares and cost. As a result, it mainly works like other corporations. So LLC or corporation is what we want to go with here. If you don't want to get double taxed, then just choose an S corporation. It's the best option for you to go with. So choose your business name and register it. You will most likely need to register your choosing business name with the state. So here's how names work if you don't know. There could be 50 businesses in the United States with exactly the same name because you can open a business with a unique name in every state, but you can't open a business that in a state where that name is already taken. So you've got to choose a business name and you've got to register that business name with the state, and then you own that business name in the state as long as you keep that corporation or entity active. However, you may also need to register in the county and sometimes the city as well. Sometimes you don't. In the county we're in, we didn't have to register anything in the city or county, and we operate a physical building here, and we don't need to do anything of that. But in a lot of other cases down the road, we would need to. So corporations may have different rules. They usually require a unique name within the state where they do business, as I just mentioned. So you're most likely to need to do a business name search. Look, my advice when thinking of a business name, if you haven't done this already, think of your name. Try to avoid terms that reflect that you're high risk. Anything financial services, credit, financial, any of that, real estate, mortgage broker, any of that stuff is high risk. Bails bonds, porn, firearms. I've got a whole list, and I think I'm working on a guide that just has these as well that you can find on YouTube. Try to avoid high names that could indicate you're in high risk because that can throw up red flags, and make sure that that name's available in your state and that you can get the domain for that name as well. A lot of stuff on credibility and more deep than we've ever dove before, breaking down the different entities and what you need to know about each one. But again, credibility becomes so important, and the majority of people that aren't getting approved for credit and financing, it's because of mistake number one, not having the business credibility set up, which is the problem. Number two, cut to the chase. You can't start at the top. Business credit building is a process. You need to know that. It won't happen overnight. A lot of people ask me this question. I love it. They say, how long does it take to build business credit? And my response is always the same. I don't know. How long did it take you to build your consumer credit? And then they look at me stunned because there's no answer to that. Like, you never stop building credit. Credit starts from inception and it never stops through the life of the business. The same as your consumer credit will never be done building until you're dead. And maybe even then it might not be dead. It might not be done because people might still use your credit. So the bottom line is this is a process and it takes some time. And how long it takes, you can get to the end in about 6 months. As I mentioned, if you really are working with an expert that knows what's going on, it could take you years if not. But remember, it never ends. It's an ongoing process. So you won't start out with a high limit Visa card right away, nor did you as a consumer. When you started building consumer credit, you started with small secure credit cards or maybe a car loan if you had a parent or somebody co-sign you if you were lucky enough to be able to have that like I was. I had a dad that helped me out with a 1990 Ford Ranger pickup truck was my first vehicle. But usually you're starting with a secure credit card. And so then you get small limit credit cards and you get higher limit credit cards and you get like Visa cards with high limits. So you're going to start a progression in business credit as well. And the second mistake that we see people make is just not following these steps and not doing this properly. So you want to start at the DNB website and get a free DUNS number. You can also go to creditsuite.com/DUNS, or you could just do a free search on Google for free DUNS number, whichever is more convenient. This is how DNB gets a company into their system to generate a Paydex score. A Paydex score will not be generated with Dun & Bradstreet until you have 3 accounts reporting with them. I get that question a lot. Why isn't Dun & Bradstreet showing my credit report? Because you don't have 3 accounts. You need 2 things. to have a Paydex score with Dun & Bradstreet and a credit report. One is the DUNS number. Two is 3 accounts reporting to them. If you don't have both, you will not have a credit profile and score with them. No DUNS, then there's no record. You're not going to have that Paydex. So once in D&B's system, search Equifax and Experian site for the business as well. And you could do that all at creditsuite.com/reports. You could search Experian, you could search Equifax, you could get set up with D&B as well. Why you want to do the search is that Equifax and Experian are different than D&B because the Equifax and Experian will create a credit report for you even when you have no credit reporting. The problem is they give you failing scores. They give you bad credit scores because you have no credit. So are you building business credit on top of a fresh, brand new profile starting from scratch? Or are you building it off of already damaged credit? You need to know that. This free search at creditsuite.com/reports will help you figure that out. If there is a record with them, check for accuracy and completeness. Then you probably want to pull credit monitoring. This search is going to net you 1 of 3 results. You'll do it. You have to look right above the search results. It'll either say that no results was found, they couldn't find your business, or it'll say that they found your business. It'll say the business name and address, and then it'll tell you a little thing beside it that says trade lines to show you have trade lines, or it'll show your name and address and no trade lines. That's bad. If you have no trade lines and they know you exist, you have a failing score, you probably want to go to creditsuite.com/monitoring to then see what's on your business credit reports. So you're going to start building business credit with what's called trade credit or vendor credit. Okay, this is called the vendor credit tier at this point. These are often net 30 terms, net 55, net 45, net 15. That means you have that allotment of time to pay the bill in its entirety. In this case, net 30 would be 30 days. These are credit issuers who will give you that initial credit even when you have none. These do 2 things that are unique. Trade vendors give you credit when you have none now, reporting on your business credit reports, and they'll give you, and they report your credit. So you want to find ones that do report and that will give you credit when you have none. Not every vendor can help like True Starter vendors can. So you want to try to work with True Starter vendors. So net 30 accounts, again, must be paid in full in 30 days. Net 60 would be 60 days. Unlike with revolving accounts, this is a set time when you got to pay it back. So our goal, this is like better than secured credit cards where you started with the consumer credit, but not as good as revolving because we don't want to have to pay the bill off every month in its entirety. We want to be able to pay off a little minimum payment to pay towards the balance. You'll get to that point, but usually vendors don't start you there. Okay. These are vendors that will grant an approval with minimum effort. So these are easier ones to get approved. You'll also want them to make sure that they're reporting to Dun & Bradstreet, Equifax, and or Experian. And I'm starting to add Credit Safe here. And people start to ask me, who's Credit Safe? Why are you talking about Credit Safe? Well, the answer is right now, you really don't need to care. Credit Safe isn't big in the United States yet, but I've been watching their growth for years, and they are huge overseas, huge overseas. So as they become a big player overseas, they're starting to make more of an impact here in the United States. So Dun & Bradstreet, Equifax, Experian is who you should care about now. But I'm going to tell you, in the next 2 to 5 years, Credit Safe is going to be a major factor that you're going to want to know about. This is why we take all of our payments that our customers pay and we report all of them to Credit Safe. We're starting to help our customers establish credit reports and scores with Credit Safe because we know lenders and credit issuers are already starting to use them. So add them to your radar as well. You want 5 to 8 trade accounts to move on to the next step. So there's a lot of questions about this. How many do I need? 3, 4, 5, 6, 7, 8, 9, 10? How many? Well, the answer is it's different for every source you may apply for. Staples may want you to have 10 accounts reporting before they'll approve you. Amazon could be 5. So I say 5 to 8 because you need 5 to 8 to start getting get approvals with most major retailers. Now, again, if you're working with us directly as a client, we tell you every single source and how many accounts you need for every source, how many you need for Staples versus Home Depot versus Sam's Club versus Walmart. But if you don't know that, that's why it takes so long. It's just trial and error. Like you'll have to apply to Staples and get denied, and then apply with Home Depot and get denied, Lowe's get denied, Home Depot get approved. Then you go and use Home Depot and go back to Staples and get denied and Office Depot approved. So it's trial and error, which is why it takes a lot of time. But you can start to get approved with about 5 to 8 accounts reporting. And again, the next step is revolving credit, or what we call the revolving credit tier. You may have to apply for more than once to get these vendors. Some vendors like Uline and Quill will deny you if you're a brand new business and have no credit established. They'll make you, in that case, don't worry. Just buy the stuff that you had originally got credit for, and then go put more stuff in your shopping cart and apply again. What we've seen is by the second or third attempt to get credit, they will then approve you. And you may need to buy some things you don't need to prove you're responsible pay online. Look, there are places like Gimplers and Granger that sell like outdoor supplies, and Gimplers is hit and miss. Sometimes they report. Right now they're reporting. Sometimes in the past they haven't, to Dun and Bradstreet. And I think that caught up with them, which is why they started reporting again. You know, Gimplers and Granger don't sell stuff that I typically need to operate out of an office. But I can buy first aid kits, batteries, things like that you need all the time. So again, just keep that in mind, that you might have to get credit with people you normally wouldn't buy stuff with, or use, or get credit or buy things that you normally wouldn't buy. So just keep in mind that that's part of it, because there's so few vendors that report. So Uline sells shipping supplies, one of my favorites. Quill sells office supplies. They report to D&B and Experian. And Granger sells industrial supplies. They report to D&B like Uline. There's their sites. There's a lot of them out there I talk about, but these are three of my favorites when it comes to getting initial business credit established, something that you want to do. So with 5 to 8 accounts, then you can start moving on to revolving store credit, what we call the revolving, or what we call the retail credit tier. Office Depot, Staples, Lowe's, Home Depot, et cetera, et cetera, et cetera. Use the company's EIN on these credit applications. So let's talk. Let's talk. A lot of things have changed here, and this is extremely important. So first of all, to get real business credit, you need to make sure they don't do a credit pull. At this stage with vendors, we don't care. Vendors are not going to look at your personal credit from what we've seen. The only one that even asks for your social is Gimplers. And if you leave your social blank, you'll still be able to come in and get approved. Okay. But now, as of May of 2018, credit cards that are issued by major banks, as many of them are, Staples, Office Depot, are issued by Citibank, for example. The major banks are required by the federal government to have a separate form filled out for you when they are asking to verify your identity. They have to ask for your date of birth. They have to ask for your social to verify your identity. Now, in most cases, that's not a big deal. But you need to make sure that you're not giving them the authority, if you do have to give them a social, that you're not giving them permission to pull your personal credit or attach a personal guarantor, a guarantee. This happened on my live stream the other day. Somebody said, I got to where you are and I'm trying to get cash credit and getting denied. I said, well, the only reason you get denied is because maybe they pulled your personal credit. She said, that's exactly what happened. Well, she gave them the social security number, which is rule number one. You want to try to avoid that at all costs. If they make you give it to them, then you need to make sure that they understand that it's only because of verification purposes, not for credit check or a guarantee. So by that, I mean, if they make you fill out a social on an online application, don't do it. Fax in an app without the social, or call them to actually do it over the phone. And then you can tell them that you don't want to get, you're not authorizing the guarantee or credit check, and you can move forward without them doing so. In those cases, you have to provide that social. So are there 8 to 10 accounts reporting? Then you can typically move on to fleet credit. So with fleet credit, and this is the fleet credit tier, BP, Conoco, Wex fleet card, RGS fleet cards. This is buying, this is to repair and maintain vehicles and also buy fuel. We don't use fleet cards. I remember back in the day, I think I applied and got denied because I don't have a fleet of vehicles. I don't have vehicles. So it's not like I'm going to use a business fleet card to fuel my personal car, right? That's commingling expenses, wouldn't do that. So this really is applicable to people in the transportation industry. You know, we have clients that have hundreds of thousands of dollars on fleet cards alone because they own tow trucks. They own 18-wheelers. It costs like $1,000 to put fuel in their tank, and they have the trucks break down and they have repairs and maintenance. It's their biggest expense. So if that's you in the transportation industry, this is going to be an important tier for you at this point. Now, if you've responsibly handled the credit at this point, paid your bills on time, now you move on to what we call the cash credit tier, Visa, MasterCard, Amex. Okay, again, try to keep the social off, but they're not going to let you do that nowadays. And nowadays, they're going to ask for it for verification purposes. You just need to make sure you're not authorizing a personal credit check, because what happens if you do? An inquiry goes on your personal credit report, and your personal credit quality then factors into whether or not you're going to get approved or get denied. Okay, you can't start with cash credit because they have requirements. Again, this is the same thing with consumer credit. You can't start building consumer credit with a $10,000 Visa card. It doesn't work that way. You start small and build up to that point to get approved. Okay, and these requirements can be a minimum Paydex score. Usually they're going to want a 78 or an 80 Paydex score. With Dun & Bradstreet, 80 score literally means that your payment is paid prompt. Payment is prompt. That's what 80 means with Dun & Bradstreet. So you need to have been paying your bills as agreed. Okay, you're going to need a required time in business in some cases. A lot of places don't care. It's not a matter of time in business. It's a matter of how many accounts you have reporting. If you show me a credit, show me a company with 15 accounts reporting, I'm going to show you a company that's going to be able to come in and get cash credit. If you have revenues over $1 million, if you have time in business over a year, then that helps make it even easier to get even more of this kind of cash credit, but not a necessity. You're going to need about 14 trade lines reporting at this point, and a high credit limit of a $10,000 before you can get in, before you can actually get in and get approved. So this is another mistake that I see people make, is that you actually need to make sure that you have at least one of those accounts has a $10,000 limit or higher to get approved for cash credit. If one of them doesn't have a $10,000 limit or higher, you're not going to get approved. Why does this matter? Please hear me here, because I'm throwing in maybe mistake number 4. Another big mistake that I see people make when building business credit on why they fail is because they're building business credit to build business credit. They're trying to get vendor credit just to get to revolving store credit. They're trying to get store credit just to get to cash credit. And they're getting credit but not using it. Your credit reports show the recent amount of credit you've used. So if you get 12 accounts and your credit report shows the most you've ever spent $100, do you really think somebody's going to give you a $10,000 limit? Of course they're not, because you're not spending any of the credit you have. You need to get credit you're actually going to use and then use the credit to start growing the business. Credit issuers see that you're using it, and they'll start giving you higher and higher and higher limit approvals. This way, by the time you get to the Visa, the MasterCard, you're getting the $5, $10, $15, $20,000 limit account, which is that you really want. You only get there if you're using the credit. Using the credit is the only reason you're going to have a limit of $10,000 or higher or ever be able to move to cash credit. And by the way, at this stage, the final stage, 14 accounts reporting, you can also get auto vehicle financing at this point too, all without the personal guarantee and credit check. Okay, so failure mistake number 3 that people are not able to get business credit is trying to game the system. Look, ethics matter. Cheating the system is only going to hurt you. I promise you that. Taking unethical shortcuts is just plain wrong, and you're going to be caught. And here's the problem. Getting caught here is a pretty severe thing. You know, in the business credit world, it's not regulated like consumer credit. Consumer credit, there's all kinds of rules of what they can and can't do, credit issuers and the bureaus. There are no rules in the business credit world. It's the wild, wild west. The bureaus can do whatever they want to do. What I mean by this is that I'll tell you the 2 things that happen most often. When you try to game the system, as I will show you what gaming the system is, when you try to game the system, there's 2 things that commonly happen. 1, the bureaus know about it and they put an alert on your credit report to notify everybody that looks at your credit report of what's going on. Or 2, you don't get that luxury. You log in and your credit report no longer exists. They shut it down. Now, we're not used to this in the consumer world because, you know, TransUnion can't just come in and wipe out our credit report. But guess what? Dun & Bradstreet sure can, and they absolutely do, because we get those inquiries all the time. You know, hey, what happened? I logged in, my Dun & Bradstreet credit report is gone on my YouTube channel. What happened? Well, I'll tell you what happened. 1 of 2 things happened. You did this or you did this. Which did you do? And they say, oh, I did this. Well, that's the result. How do I fix it? You don't. You start over. That's what happens. You start all over from scratch. So one way business owners try to game the system is by buying shelf corporations. A shelf corporation is age corporation. So it looks like what happens. Somebody goes and buys a corporation. In Florida, it's only $70. They buy a corporation and they don't do anything with it. They let it season. They let it sit on a shelf. And all they do is pay the annual fees every year just to have the corporation open so it looks older than it is. But the credit reporting agencies and banks these days will look at the date ownership was transferred. So here's what happens. Your business credit reports have what's called a family tree. showing other organizations that may be part of your corporate, your main headquarters, and they also show all your ownership changes. So what happens is when your credit report shows an ownership change occur, let's say you buy a 3-year-old shelf corporation. Well, your credit report reflects for that business that the ownership changed today's date, okay, November 2018. Then that throws up a red flag in the computer system of lenders and credit issuers. And then what they do is they oftentimes default to the date the ownership changed or the date the bank account was open as the startup date. So think about this. You spend $4,000 for a shelf corporation to make it look like you've been open for 3 years. Ownership changes from the person that sold it to you. And now the day the ownership changes, banks and credit issuers look as the date of inception of the business. And you just spent $4,000 for a corporation that now looks brand new to lenders and credit issuers when you could have spent $70 for the exact same business. So they will see this ownership transfer. And then once they do so, they re-age the business to that date, not the date the business was open. So you won't get a time in business boost this way. It's not going to help you. It's just a complete waste of money. Now, don't get me wrong. Shelf corporations, they had their day. There's still some people selling them that are trying to hold on. But it used to be that you couldn't really set up businesses quickly online before the internet, right? So it took a long time to set up business entities. So to set up and buy an entity that was already set up was simple. It made a lot of sense. But nowadays, this just doesn't make sense because these lenders and credit issuers know what to look for, and you don't get the benefit of the re-aging the business. Another way to try to cheat the system is buying CPN numbers. Okay, a credit privacy number is or it's called a bunch of different things. CPN, SCN, secondary credit number is a 9-digit ID. It can be used as an identification number for people when needing extreme privacy. Like a social security number, a person can only have one CPN. It's used as a unique identifier for your financial transactions that lets lenders and credit reporting agencies keep an eye on your borrowing history. So here's what happens. People that need CPNs need privacy. Here's some examples. Senators, government officials, the president. Here's another example. People in witness protection. But here's the thing is that, CPN numbers only really exist for those extreme privacy. People are trying to sell them, acting like you can do away with your bad credit on the consumer side and buy one of these and start a new credit profile. But that's just not the case. These are meant for people that actually need extreme privacy. So people are buying those to try to get out of their bad credit. But again, you're required to give a lender your social security number when applying for credit. You're not required. There's no law that says you must give lenders and credit issuers your social security number when you apply. You can withhold any information from them and they can deny you as a result. But what you can't legally do is misrepresent your social security number. You can't put anything other than a social security number in a social security number field. You can go to my YouTube channel, and on youtube.com/credit suite, we have a whole training on CPNs. But here's what you need to know. You have never in your life, never once, ever, seen an application that asks you for a SSN or a CPN. You've never seen it, ever. They only ever ask you for an SSN. Well, you can't put a CPN number in an SSN field. It's misrepresenting your social security number. It's 2 felonies. Not an attorney. Look it up. You can't misrepresent your social by putting anything in a social security number field other than your social. So you can't use a CPN and try to act like it's a bogus or it's a new social because no application asks for a CPN. It only asks for an SSN. So this is why it just makes no sense for you to try to use a CPN number. Okay, if you choose to withhold your SSN from a lender and you wanted to not become a criminal, then you could leave that field blank. But if you put anything in place of it, then you just committed actually 2 federal crimes. And again, I'm not an attorney. You can verify this. Okay, the other thing to keep in mind is that most CPN numbers that are sold are either of children or people that are deceased. So to make matters worse, not only could you be misrepresenting your social, which is 2 federal crimes, you could be using a stolen social security number, which opens you up to all kinds of crazy liability. So stay away from these that are just bad news. Okay, another way people try to game the system is by buying business trade lines. Okay, there are many companies online which promise to sell seasoned trade lines. And the idea here is that if your company has poor or little credit, you can, for several hundred or $1,000, have your business piggybacked onto the account of someone with established excellent credit. Therefore, new business owners seem to be more creditworthy than they really are. Here's the whole idea behind these. Well, piggybacking uses creditworthy borrowers' accounts to improve the credit of an unrelated third party. A creditworthy borrower adds the third party as an authorized user of his lines of credit, but he or she doesn't actually provide the third party with the ability to use that credit. So they're just getting credit for the reporting, not actually being able to use the account. So the authorized user can never actually use that credit. A company offering these maintains a network of these kind of card holders, and they stand ready to sell for a fee the ability to add you to those accounts. Okay, the company that offers a selected trade line, and then they charge you a fee per the account. Now, the FBI has found that the trade line company can be a fake, and the primary cardholder can be a stolen identity in these kinds of scams. That's one problem from these, apart from the ethics and keeping a clear conscience. Okay, but the other problem with these, the other problem with buying trade lines is that, again, what happens is the bureaus know the companies that sell the trades and the trades they're selling. When they recognize a trade of trade for those companies on your credit report, immediately the bureaus throw up an alert. I know, because we try to help clients get those alerts off the credit reports. We see them all the time. The second thing that happens is if they know you bought the trade lines, they just shut down your credit profile. And this is where things get really sad for people. Somebody bought 2 fake trades to start a credit profile. They built 20 real trades on top of the fake. DNB figures out that one of the 2 initial trades was fake, and they shut down the entire credit profile immediately, and all that credit basically gets pulled back from the credit issuers because the credit profile goes dead. So this is what happens quite a bit. And again, people come to us and go, oh my gosh, this happened. My credit profile is gone. What happened? What did you do? Did you either buy a shelf corp or did you buy trades? Which did you do? And then they tell us which of the 2 they did. And we say, well, your credit profile is gone. You have to start over. Now, people yell at me on YouTube, and the people that will comment to this video and any other video on this topic tell me how wrong I am. And then I ask them for clarity on where I'm wrong, and they never reply. Those are all people that sell these. So anybody that sells these will come to the defense of them. And let me say, on the consumer side, I see the benefit. If you use consumer credit and get trade lines, it makes sense. You can add authorized users. And since length of credit history accounts for 15% of your score, it can help you. But in the business world, this doesn't help you. First, you can get real vendor credit accounts anyways. And secondly, the minute they know you've done this, they just shut down your credit profiles and scores. So apart from the ethics and keeping a clear conscience, these schemes are expensive and they don't really work. If anybody knows you're part of these, well, then you could be committing a federal crime based on those cases where I talked to you about that as well. So again, a recap. Not everyone can succeed at building business credit. There's many reasons that people fail. The main ones are failing to build that company credibility. Okay, company credibility is what gives those lenders is the assurances in the beginning that you have a real legitimate business. The second is try to jump the gun. Business credit building is not an overnight process. Do the steps in order and avoid the frustrations. The process has a particular order, as we talked about, the vendor credit, moving on to the retail credit tier, moving on to that cash credit tier. Okay, the less said about unethical practices, the better. So don't do any of those things we talked to you about not doing. And if you have any questions along the way, or you want to take what could take you years on your own and condense it into months, well, then give us a ring, 877-600-2487, info@creditsuite.com. You can also visit us at creditsuite.com, top right of our page. We go live on Facebook almost every week. We go live on YouTube weekly as well. And we also have daily tips on places like Instagram, Twitter, Facebook. Not to mention that we even have our own podcast that has over 100 episodes and over 100,000 downloads, where a lot of people are listening to this kind of training on the go. So make sure you subscribe on Instagram there. So I thank you for tuning in. I will be back next week for another cool topic where we're all about how you can get the most money for your business. What we do here at Credit Suite is we just pull the veil back and teach you how all these things work, how to get business credit, how to get the credibility, how to get financing, how to offer these things as services, as a service, how to do everything relating to getting money to fund your business. If we can ever help you along the way, reach out to us, 877-600-2487, info@creditsuite.com, or visit us at creditsuite.com. Thanks, everybody. Have a great day.